Hey there, can you hear me?
Yes, good morning, Jason, and good morning or afternoon, rather, to everyone listening in today. Appreciate you spending your time with us. My name is Lance Gunkel. I'm the managing director for Severson Strege, and I am joined by Jason Gunkel, our firm's chief investment officer. So, Jason, give us the quick update. How's your family holding up under our current conditions? I hope you guys are swimming in hand soap and toilet paper.
Family is doing well. I feel a little bit like Bill Murray in Groundhog's Day, where each day kind of seems like the same. And my wife is a elementary school teacher, so she has found about 1,001 creative ways to make a craft out of the cardboard toilet paper roll.
Well, that doesn't sound too bad. If she wants to come over to my house and help us from a distance, that would be appreciated.
Yes, it keeps the kids busy.
All right. Well, a couple of quick items for everyone listening in. Jason and I will go through an update on what's going on in the economy as well as the financial markets. And afterwards, we'll take your questions. You can feel free to submit those at any time, and I'll just sort through them when the time comes. If you'd like to enter a question, you can go to your Zoom tools. You're probably all very familiar with Zoom at this point. It seems to be the software of choice these days. But if you use the Q&A box or logo, submit your question there, and we'll filter through them that way. So to start us off, let's take a look at the economy. And we're obviously going through some deep economic struggles at this point. Many businesses are closed, or if they are open, they are simply limping along at reduced capacity. Over the last month, we've seen an escalation in unemployment. I believe we've now seen about 30 million unemployed individuals as a result of COVID-19 and closures. And we're seeing that now reflected in some of the economic growth data. The figure for GDP in the United States came out earlier this week. And we saw a decline during the first quarter of 2020. If you were to annualize that decline, it works out to about 4.8%. Our economy today is very much driven by the service sector. Now, of course, this was not always the case. In 1920, about 26% of the US population worked in the service industry. Today, that number has flipped, so now it's 86%. So our economy is heavily dependent upon the service industry. And service, unlike, say, a manufacturing firm or those companies in retailing or agriculture, they're not able to hold on to inventory to sell at a later date. There's no second chance to sell a hotel room for a particular night, or to sell a plane seat, a concert ticket, a haircut, an Uber ride, or a drink. So this is revenue that has essentially vaporized, and it's not simply deferred spending. So having lost now many weeks of revenue, service businesses are deeply in the red. So the the question comes, what does a recovery, the eventual recovery, look like? And a recovery really can't begin until we see the lockdowns ease. And at the same time, we see a proliferation of antibody tests. We believe that that will start making people feel more comfortable and more able to go out and participate in the economy and enter service establishments. So when that happens, it's likely that service firms will begin to walk as opposed to run towards greater sales. And what I mean by that is that businesses will have to use ingenuity and do things a little bit differently. And if they're able to do so in a meaningful way, they'll have an advantage over other companies. And this means re-engineering the way they do business to face the new realities. So, for example, that could mean factory lines being reconfigured for physical distancing. It could mean that in-person events such as conferences hand out N95 masks. It will very likely mean the faster adoption of new technologies. And it could also mean a change in our supply chain system. We saw the advantages for decades of having a world where we were able to source materials from abroad, and that resulted in lower prices really across the board for some of the consumer goods that we would purchase. We're now seeing that the disadvantage is that it can be harder to source materials when those global supply chains are jammed up. So, Jason, I think I will turn it over to you with a few questions I had for you regarding how the market has reacted to all of this. We know that initially, during really the period of March, the whole month of March, the U.S. market in particular was very volatile. And while it continues to have some volatility, it at least feels to me a little bit more settled. Things are settled down from where they were. The S&P 500, which tracks the U.S. stock market, it has increased since its low on March 23rd. In fact, it's up about 31% since then. And I am using data as of middle of today, which is May 6th. So, Jason, in your opinion, has the market become too optimistic in this recovery?
It may have become a little too optimistic. One particular measure that the market tends to look at is the price to earnings ratio. And there's different variations of the price to earnings ratio, but if you look at the 1 year forward price to earnings in February before the virus hit, the price to earnings for the S&P 500 was about 19. The long-term average is around 16. So it was trading a little expensive, and by a lot of measures, we thought it was a lot expensive before the market drop. But what happened is as the market fell, initially the price to earnings ratio got to about 13. So it was looking more cheap. But now after April, and April was the best month that we've had in the stock market since January of 1987. So the stock market had a great rebound. And at the same time, you had a lot of S&P 500 companies that were revising their earnings estimates for the second quarter and beyond. So the market was shooting up. Forecasts were shooting down. And now the price to earnings ratio all of a sudden stands at about 21. So even at a higher point than it was before the big market drop. So that would indicate that we've gotten a little bit ahead of ourselves. Of course, the stock market looks forward and is ahead of the economy, but by most accounts, most experts believe that the stock market is a little bit too far ahead of the economy right now.
Yeah. So that brings me to the next question: is how much is the market reaction the result of the Fed stepping in with some assistance and entering the bond market and providing some liquidity there? How strong is that support from the Fed, and can it last?
The Federal Reserve and also the federal government with the stimulus bill definitely helped stabilize the market, and they're definitely responsible for part of the recovery. But they've already spent close to $3 trillion, and there's debate as far as how much more support they can provide. I think probably what was the biggest reason for the recovery in April was the more optimism about businesses and the economy reopening. So we have to credit the Federal Reserve for stabilizing the markets, creating more liquidity, particularly in certain areas of the bond market. But as far as the rally goes, I think we have to contribute that to people being more optimistic about the economy reopening. And I think going forward, it'll be much more dependent on economic activity rather than actions by the Fed.
So next set of questions for you, Jason. I'm just going to keep them coming if you don't mind. Maybe I'll go a little out of order here, but maybe those listening have heard of a U or a V-shaped recovery. So maybe if, for the benefit of all of us, you could describe what those two recoveries are. What does U and V mean, and which one may we be likely to see?
Yeah. So two of the most common types of recoveries are referred to as a V or a U, and they just refer to, if you look at a graph of the GDP, that is what the shape of the graph would look like. So if you picture a V, we had a very sharp fall in GDP. And so the question is, how will the recovery of GDP look? Will we get a very quick recovery, and so the shape will look like a V, or will GDP remain fairly level for a time period and then recover, which looks more like a U? And I think initially when the virus hit, people were optimistic that it would be a V recovery. We were hopeful that the economy would be shut down for a shorter period of time, and then people would quickly be hired back and GDP would quickly recover. That has been more of the pattern for previous pandemics. But this pandemic has proven to be different, and unemployment has gotten much higher. It looks like it's going to drag in the economy for a longer period of time. So most economists now believe we are headed towards a U recovery, where GDP is going to be flat for a period of time. And I've read different estimates. I've read it might be flat for the remainder of this year. I've read it could be flat for the remainder of next year. That obviously is yet to be determined, just because we don't exactly know what the recovery from the virus looks like. But definitely the consensus now is we are headed towards more of a U-shaped economic recovery.
Yeah. And of course, just kind of reiterate what part of what you mentioned there is that nobody knows the answer. Of course, where everybody is hungry for data and information, and everyone wants to figure out how this will end. But of course, at this point we're still guessing. So, Jason, are there particular segments of the U.S. market that have done better than others?
There are. There has been a very wide dispersion of returns. When we look at different areas of the market or different sectors, so we know that the energy sector, and particularly oil, has taken a big hit. That is the worst performing sector. Energy sector through yesterday was down over 40% as part of the S&P 500. And some other sectors that have struggled are financials and the industrials, which includes the airlines, have struggled as well. But there's been a couple sectors that have done fairly well, and technology is one of them. Technology stocks are only down a couple percent on the year. Healthcare stocks have done very well, and utility sector has done well too. So those three sectors, healthcare, utilities, and technology, have really propped up the market. And we tend to see those sectors do much better when the market falls. And I think it's also worth noting, as we look at the technology sector, 5 companies that we're all very familiar with, Microsoft, Apple, Amazon, Google, and Facebook, now make up about 20% of the total value of the S&P 500. So there's 500 companies in that index, and just 5 of them make up 20% of the total value. But it happens to be that those 5 companies are actually averaged a positive return of about 10% year to date, which is really unbelievable when you think about it. But a couple of those companies, such as Amazon and Microsoft, have done very well, and they've benefited from people staying at home and ordering goods on the internet, or using different areas of virtual technology. And so it really has propped up those companies, and therefore propped up the technology sector and propped up kind of the more growth-oriented side of the stock market.
Yeah. Well, much of the future growth for businesses will be determined by whether or not consumer behaviors are changed as a result of this virus. And I've read a lot on this topic, and you can imagine that opinions spread the whole spectrum. There are those that believe that people will behave maybe a little more isolated. They'll stay home more, travel less, won't go to big sporting events or conferences. And then on the flip side, there are those who believe that we will realize just how much we depend on one another and enjoy the camaraderie of being around other people, and we'll go back to business as usual. So, Jason, knowing that this is just an opinion, do you have any thoughts on that? Whether we'll see any lasting change, or will it be shorter term in nature?
I think there's definitely going to be some lasting changes that we see. One thing that I've heard, I guess, on the business side of things, is that some companies have really been surprised at how productive people have been at working from home. And so they think they can keep up the productivity and maybe lose some of their office space permanently. I have a neighbor that works for a large company nationally, and they've already announced that the majority of their workforce will stay home permanently. So I think that is definitely one trend that you'll see. And that could have a trickle down effect. Maybe it'll have a bad effect on commercial real estate prices. That could be one effect we see. But that's just one example. How about you? Do you think there's other long-term effects we might see?
Well, I think by and large, people's memories are fairly short. I think we'll see, until there is a vaccine, I think people will tread carefully on the whole and maybe avoid large group events. But I think more things will be back to normal than we expect. I think it's easy for us to mentally take what's happening in the here and now and extend that over a very long period of time. So we'll see. Your comments about more people working from home, I think there's advantages for both employees and companies if that happens. Of course, it doesn't bode well for commercial real estate. And of course, commercial and retail real estate will likely also face a pinch from businesses going under as a result of losing business over these period of weeks. So we'll see what happens there. Jason, I thought before we take any further questions from those listening in, we could just go through kind of a summary of what's going on in the markets from a pros and cons perspective, and then what the implications are for how we're managing portfolios. Would you mind running through that for us?
Sure, you bet. So some of the positives happening in the market, we've talked about the Fed stepping in, the Federal Reserve, and also the federal government through stimulus. They have stabilized the markets, so that's definitely a positive. We also have been talking for a while of how the stock market has gotten a little expensive or a lot expensive and was due for a correction. Obviously, we did not predict the coronavirus, but now the market does look to be trading at more reasonable levels. And also on the positive side, the economy is starting to reopen. And, we've already seen with the performance of the stock market in April of how that has really boosted returns. So there's a hope that the economic shutdown can be on the shorter side and people can get back to work. On the negative side, it is possible that this epidemic or the shutdown across the economy is prolonged. So unemployment now, in the last 6 weeks, there's been about 30 million people who have filed for unemployment benefits. And I've seen some different numbers, but I think the unemployment rate now stands somewhere between 15 and 20%. So it is yet to be determined how quickly businesses will rehire these employees. Certainly, as companies reopen, many of them will get rehired. But like we saw at the end of the 2008-2009 recession, some companies were hesitant to hire back all their employees, and they preferred to operate a little more lean just because they were not quite sure what to expect going forward. And so I think it's possible that the unemployment rate remains elevated for a period of time. So what does all this mean for our portfolios? Well, heading into the year, our portfolios were more defensively allocated. And what does that mean? We did tilt a little bit away from stocks, have a little lower allocation to stocks. We also, towards the end of last year, we added an allocation towards more defensive type companies. So the ones that I talked about in healthcare, consumer staple companies, those type of companies we did add to the portfolios. And what we're going to be doing as in the months ahead, if the stock market starts to be trading at we think, a good valuation level, so we are going to continue to pay close attention to the price to earnings ratio and some other metrics. We will try to purchase more stock at a discount, and hopefully that will increase the growth of your portfolios as the stock market recovers. And some of the things that we've already been doing, we've been rebalancing the portfolios. So what does that mean? Well, we have done this as long as I can remember. Every single quarter, we rebalance portfolios to their target weights. And so if you have a stock market that has fallen, and so stocks are maybe trading below their targets, and you have bonds that have held their value better, bonds would be trading above their targets. So what you do is you rebalance the portfolio, which will buy more stock, sell some bonds. And in that way, you're really buying stock at a discounted price and selling other assets that have maybe risen in price. So that can prove to be beneficial. And as the market volatility continues, we'll look to rebalance a little more frequently. We might look to do that maybe more on a monthly basis instead of a quarterly basis. And then also, we've already taken advantage of harvesting some losses that have occurred in portfolios, which is beneficial from a tax perspective. And we will look to continue to do that if the market drops.
Yeah, that's a great summary. Thank you, Jason. A reminder to everybody listening in, if you have a question for us, you can submit that by using the Q&A dialog box. Just type in your question. We'll do our best to answer it for you. Jason, a question that came in covers the topic of U.S. versus international exposure. And in all portfolios, or most portfolios rather, there would be a stock and a bond component. And then within each of those, you'd have a certain portion dedicated to U.S. stocks and foreign stocks, U.S. bonds and foreign bonds. So entering the year, for the stock portion of portfolios, we had an equal weighting between U.S. and foreign stocks. Jason, has that position remained, and if so, why?
That position has remained across most of our portfolios. And what we really like is the forecast of international stocks. Their valuation does look a lot better compared to U.S. stocks. This can tend to be cyclical as well, as we look at what performs better, U.S. stocks or international stocks. And as we look back, U.S. stocks have done better. U.S. stocks exceeded expectations over the previous decade. It looks very likely to us that over the next decade, you'll see international stocks perform better than the U.S. However, investing internationally comes with more risk. So we pay close attention to that. We don't want to take too much risk in a portfolio. And also, as our investment committee gets together to discuss, how the markets look after this epidemic, we're going to have some good discussions and do good research on how we think these economies will come out of the pandemic. So, that could change. It's possible that we increase the exposure to U.S. stocks if we think the U.S. market will come out of this recession better than the international market. So that's something that is fluid and could change, but definitely will be a key topic of discussion with our investment team.
Yeah, that's right. We have a question surrounding inflation and how market volatility or this pandemic has or will impact inflation. And Jason, maybe I can try and tackle that one, and then you can add on to it if need be. When we look at inflation, there are really two factors necessary to cause inflation. So that would be an increase in the money supply, how many dollars are in circulation. And then second is what economists call the velocity of money, or how fast that money is being spent. And when you have an increase in the two, that causes inflation. So what we've seen now as a result of the pandemic is the assistance of the Fed in increasing the money supply. So that's one element or one portion of the inflation equation. The question then becomes, have we or will we see an increase in the velocity of money in spending? And so far, that hasn't been the case. In fact, if we go all the way back to 2008, when we faced that credit crisis, the Federal Reserve pumped many trillions of dollars. I don't know the figure off the top of my head, but they pumped a large amount of money into the money supply to aid in the recovery. The economy did recover, of course. We had a roughly 10-year bull market. And over that 10-year period, we didn't see an increase in how fast money was being spent. Velocity of money did not increase. And that's why inflation has been so low for so long. So I guess the answer to the question will depend upon how consumers change or react after this pandemic is gone. The hope is that the velocity of money will become faster, that people spend more dollars. But as that's done, it's the Fed's job, and this is the tricky portion. They need to then take some of that money supply out, reduce the circulation of money. And they have to get the right balance in order to keep inflation steady where it's at. So I don't know if I would even hazard a guess, but my opinion is that over the last decade, the Federal Reserve has made relatively good decisions in knowing when to pull the reins on the money supply or change interest rates. So we'll keep our fingers crossed that they continue making those right decisions. Jason, would you add on any pieces there?
No, I think that's a good summary, and I think most economists still do expect inflation to remain relatively low over the coming decades, unless economic activity picks up significantly, which we can all hope it does. But like we've seen the last decade, the Federal Reserve has been, very free to offer money at a cheap price, and economic activity has remained low enough that it's kept inflation in check.
Yeah. So a somewhat related question. We talk about the Federal Reserve increasing money supply. Also, there's the federal government has increased the amount of debt that will need to be raised in order to supply funds for the various stimulus packages that have been put into place. Other countries are taking different but similar measures. Jason, how do you balance out, the impact on raising government debt versus the benefit that can provide to individuals? How do countries, make that decision, or how do we think the impact will be for citizens of those countries?
Well, let's see. How much time do we have here? It's kind of a difficult question to answer, but I think those economies in the short term are forced to take on debt just to help their economies survive. but the long-term implications, could be pretty significant. And, people have been concerned about the level of debt that the U.S. has taken on in the last, several decades, I guess. But the U.S. is in a, more advantageous position, and so far that has not hurt the U.S. economy. But there's other countries around the world that are not in as good a position as the U.S., and it could definitely hurt their economies. It could hurt the value of their currencies, and therefore be more detrimental to their economy. So it's very, I guess, difficult to answer it with a very short summary, but it could have a very significant effect on countries across the world, particularly those that are smaller in size.
Yeah. I sorry for throwing the fastball high and inside on you there with that question. And maybe I'll just add to that. Many economists have shown that there's a healthy level of government debt that can be serviceable and provide benefits to the citizens of that country. Some do worry about reaching elevated debt levels. A good case study there is Japan. They had high levels of debt and have had a flat economy for a very extended period of time. And while neither Jason nor I are economists, so we're maybe speaking a little bit out of tune here, but one advantage the U.S. has is that the U.S. dollar is the reserve currency, and that's kind of a baked-in advantage. It's almost like free money, so to speak. And we'll have that advantage as long as the U.S. dollar remains the reserve currency. So again, fingers crossed that continues. Well, Jason, I think we've answered all the questions that have been sent our way. Let me just do a double check, make sure I haven't missed anything. Did have a question come in related to the ag economy in Iowa in particular, and Jason, maybe I can tackle that one. Of course, many of our clients are either farmers or have a business in the vast ag economy. And many of those businesses were facing a difficult situation even before the pandemic hit, with reduced trade with China and other countries due to some of the tariffs that were put into place. So they were already in a difficult situation. And what I have heard through the grapevine or through other clients is that they've been hurt even worse as a result of the pandemic. So I'm certainly not an expert in that industry. I don't know what the way forward is or what that would look like, but I do know that many in that space are struggling. Jason, do you happen to know if any of the government stimulus that's been passed has been earmarked for the ag community?
I don't know that for sure. I think there's definitely some ag businesses that would qualify for the different loans being offered, but I don't know if there's anything in there that specifically was targeted towards farmers.
Yep. Okay, Jason, I think we have answered all the questions that have come in, and maybe just to put a close on our time together today, just remind everyone that in this current environment, it's easy to get anxious. particularly about finances. And I would just remind you that the work that you've done ahead of time to put a financial plan in place should give you some ease. And if you're still nervous or have questions, please, I encourage you to reach out to your financial planning team. They can answer any specific questions that you have related to your situation, and just, remind you of all the good work you've done leading up to this. So with that, I'll send out an early Happy Mother's Day to all the mothers out there. And just in case Jason, our mother, is listening, we'll give her a thumbs up and a wave.
Happy Mother's Day.
Yeah. Thank you, everyone, for joining us. Jason, thank you for co-hosting with me. And we wish everyone a great week.